Welcome to The Debate. Today we are diving into a deep structural analysis of two global giants that share the grocery aisle but almost nothing else, PepsiCo and the Coca-Cola Company. Despite over a century of fierce public rivalry, we still see this persistent consumer misconception that suggests some form of, secret corporate unity or shared ownership.
And that's interesting, but for our purposes, that consumer confusion isn't really the core issue. I think the question has to be framed a bit differently. We need to be asking, how fundamental is the complete corporate independence of PepsiCo and Coca-Cola? And maybe more importantly, what measurable direct impact does this separation have on global fast-moving consumer goods or FMCG wholesale strategy and market structure?
Right, and I'll be arguing that the structural independence is absolute, it's historic, it's paramount. It's visible in everything from their corporate governance and their separate stock exchange listings to their fundamentally contrasting business models, one prioritizing a deep beverage focus, the other aggressive diversification. This independence drives every strategic decision they make.
And I'm going to focus on why that separation translates into critical material implications for importers, distributors, and bulk sourcers. For the professional buyer, this independence dictates the entirety of their logistical planning, their contract negotiations, and the specific financial valuation they assign to long-term supply relationships. It's not just some corporate fact, it's really an operational imperative.
I see why you emphasize the operational side, but I think we have to start with the bedrock of their separation. PepsiCo, trading as PEP on the NASDAQ, and the Coca-Cola Company, traded separately as KO, they operate as two fundamentally distinct publicly traded corporations with zero cross-ownership at the corporate level. This isn't just a matter of different ticker symbols. It represents two separate regulatory frameworks, two entirely distinct boards, and two competing global leadership teams.
Sure. That independence is not disputed, but its context is crucial. You're right to note that major institutional investors, like Vanguard and BlackRock, hold substantial stakes in both. For instance, Vanguard holds over $20 billion in PepsiCo stock, but those holdings are managed as distinct, competing portfolio components. The separation is so ingrained that even when capital flows through the same firms, the financial analysis treats them as rivals vying for similar shelf space, but operating under radically different risk profiles.
Exactly. And the most compelling evidence of that independent strategic direction really lies in their business models. Coca-Cola remains overwhelmingly focused on the beverage category, commanding nearly 50% of the global market share there. Conversely, PepsiCo is structured as a diversified food and beverage powerhouse. The inclusion of massive snack and food brands like Frito-Lay and Quaker Oats means PepsiCo generates, double the total annual revenue, over $91 billion compared to Coca-Cola's $42 billion. That difference in revenue composition is the clearest indicator of their divergent strategies.
That's a compelling snapshot of their scale, I'll give you that. But I would argue that this structural reality creates the transactional complexity. It doesn't just confirm the rivalry. The independence, expressed through that diversification you mentioned, fundamentally alters how a wholesale buyer engages with them. Coca-Cola offers a relatively, pure-play beverage portfolio. But when a distributor signs a contract with PepsiCo, they're often negotiating with an entity that views beverages as an anchor product for their wider, higher-margin food delivery infrastructure.
So are you suggesting that the diversification muddies the waters for the buyer, or does it just provide a greater opportunity for negotiation?
FMCG beverage skew like Pepsi. They can't leverage a relationship with Coca-Cola to improve terms with PepsiCo, or vice versa. You are dealing with two massive proprietary systems that have been engineered to remain independent in terms of procurement, logistics, and material management, even if their products end up sitting right next to each other on a shelf.
Okay, let's talk about the source of this persistent consumer misconception, because I think it highlights the psychological effectiveness of their competitive strategies. The confusion, it originates from the deliberate Cola Wars marketing, the shared red branding elements, the aggressive co-location in retail. This rivalry is over 120 years old. It's completely intentional. Both companies thrive on the direct comparison, which, inadvertently creates this false impression of corporate unity.
That psychological rivalry is certainly effective on the consumer, I agree. But for the professional market, the strategic differences are far more consequential than shared red labels. PepsiCo's independence allowed it to execute that highly successful diversification strategy. This integrated model, well, it provides crucial revenue stability because it hedges against volatility in commodity prices or regional beverage demand. A drought might impact beverage pricing, for example, but Frito-Lay sales could remain strong. This diversification is a risk mitigator, which fundamentally changes the profile of PepsiCo as a long-term supply partner compared to the very beverage-focused Coca-Cola.
Well, that brings us directly to the financial strategies, which I believe solidify the contrasting philosophies far better than market stability arguments. We see profoundly different profitability metrics precisely because of these independent structural choices. Coca-Cola chooses to operate a highly capital-light model, the concentrate producer framework, where they often just sell the syrup to franchise bottlers globally.
The pure play model.
Exactly. They minimize asset risk, pushing the high cost of bottling, warehousing, and distribution onto third-party partners or license affiliates. This focus on high-margin royalty revenue is why Coca-Cola consistently maintains a substantially superior net margin, recently reported at around 22.59%. This is proof of a focused profitability maximizing philosophy.
I acknowledge the margin is strong, but profitability metrics only tell half the story, don't they? The capital-light model, while it yields high margins, it sacrifices control over the final mile of distribution, and that potentially impacts product freshness or speed to market. This is where PepsiCo's independent strategy, vertical integration, particularly the direct-to-store delivery or DSD system for snacks and often for beverages, really comes into play.
But their margin suffers dramatically because of this integration. It sits at around 10.43%. That margin is significantly diluted by the sheer operational expense of owning and managing bottling plants, truck fleets, and delivery personnel for the snack and food divisions. That is a measurable trade-off for control.
And it is a trade-off that many sophisticated wholesalers and distributors actually favor. While the net margin is lower, the DSD model, which is inherent to their diversified structure, gives PepsiCo maximum control over inventory rotation, merchandising quality, and speed. For a wholesale buyer, dealing with a partner who maintains such granular control over their supply chain often translates to fewer stockouts and better quality control, justifying the slightly lower margin performance. I'm just not convinced by the argument that higher margins equate to a universally superior strategic partner.
That's a compelling point, but I would frame it differently in terms of investor perspective. Long-term corporate independence is validated by superior valuation over time. Coca-Cola historically commands a premium valuation because of the stability and low asset risk inherent in its margin model. While PepsiCo's stock did surge recently, in part due to strong performance in its Frito-Lay international divisions, investors still often trade Coca-Cola at a significantly higher forward price-to-earnings ratio, currently around 22.26 times compared to PepsiCo's 17.66. That PE premium reflects market trust in the consistency of Coca-Cola's capital-light, high-margin structure.
That might be true for a long-term institutional holder, but for a wholesale sourcing entity, that PE ratio divergence just indicates different stability and growth profiles. PepsiCo's ability to leverage diversification provides a resilience, which is a tangible benefit when you're structuring multi-year contracts. If one category softens, the other supports the entire corporate structure. This resilience is a practical risk hedge that the professional buyer has to consider when choosing between two independently managed supply partners.
I do acknowledge the strength of PepsiCo's risk mitigation strategy resulting from its independence. But let's bring it back to the critical operational separation. Their strategic choices necessitate completely separate proprietary formulations, separate R&D facilities, and crucially, separate global supply chains. This is really where the rubber meets the road for the importer.
Precisely. And this is the most critical material implication of their independence. Distributors sourcing bulk quantities of high-volume SKUs must establish fundamentally separate procurement contracts for Pepsi and for Coca-Cola products. You cannot streamline logistics between them. If you're sourcing a container of Pepsi, you're coordinating with a PepsiCo-controlled or licensed entity. If you're sourcing a container of Coke, it's an entirely separate transaction, invoicing, and logistical coordination point.
Okay, but why is that level of separation not simply manageable business complexity for an experienced global importer? Doesn't the aggressive competition between these two, who, along with Keurig Dr. Pepper, controls 70% of the global soft drink market, doesn't that ultimately drive greater efficiency?
The complexity is manageable, sure, but the consequences are real. The independence means bifurcated contracts and segregated logistics. For sourcing, this leads to two completely different regional supply protocols. For example, PepsiCo's integrated model allows them to push combined orders, optimizing truck utilization by mixing beverages and snacks. Coca-Cola's focus means their logistics are optimized purely for liquid distribution and merchandising, often leading to different pallet configurations and loading protocols. This separation requires specialized knowledge to minimize shipping costs and maximize container utilization.
But that specialization is the benefit. The independence forces each giant to constantly optimize its chosen distribution model. Coca-Cola is perfecting the high-margin, asset-light distribution of beverages across every major global economy. PepsiCo is perfecting the synergy of food and beverage deliveries, especially as they pursue strong international growth in emerging economies. The competition inherent in their independence is the driving force behind these sophisticated competing logistical systems which, at the end of the day, keep pricing competitive globally.
The competition is the framework, yes, but the independence is the foundation upon which two entire global supply chain empires are built, and they never touch. For professional wholesale buyers, this means every single negotiation, from price to regional packaging availability, must be executed twice, under two separate sets of corporate rules and two separate distribution philosophies. This is why the structural reality of their independence is the most crucial piece of information for optimizing a global sourcing portfolio.
Then I think our debate really confirms that the consumer misconception of shared ownership fundamentally diminishes the reality of this century-long, ferocious, and strategically divergent rivalry. PepsiCo and Coca-Cola are fiercely separate competitors. Their contrasting corporate philosophies, one focused on maximizing beverage penetration and margin through a capital-light model, the other on diversified revenue generation through integration, are absolutely evident in their financials and corporate structures. Their separation is definitive, and it shapes market behavior globally.
And that independence is far more than just an academic or historical fact. It is the definitive operational framework for all global FMCG trade. It dictates supply chain resilience, risk assessment, contract negotiation strategies, and distribution portfolio planning for professional buyers worldwide. Navigating the complexity of two independently managed, colossal global supply chains requires some very specialized expertise.
And for professional buyers sourcing high-volume FMCG beverages like Pepsi in bulk, at competitive pricing, the partner who can successfully navigate these distinct, separate supply chains is invaluable. Asia Grocery Company, that's Asia Grocery Wholesale, or AGW, is a trusted export partner that manages this complexity daily. Understanding this complex, separate ownership structure is really the first crucial step toward optimizing your wholesale strategy.
We'd encourage listeners interested in sourcing these or other fast-moving consumer goods and who want help managing the logistical intricacies of competing global giants to visit egrocery.asia and contact AGW for wholesale inquiries. There is always more to explore when analyzing the powerful, independent strategies of these truly separate corporate empires.